You have money in your account right now. You can see it. The number is sitting there. Maybe it's enough to cover rent for 3 months. Maybe it's years of work. Maybe it's everything you have. It doesn't matter how much. What matters is that you believe it's yours. That belief is the most expensive illusion in modern finance, because there is a version of your life not in some dystopian future, not in a history book from a century ago where you wake up one morning, walk to a bank, and are told you cannot have your money, not because you did anything wrong, not because the bank collapsed. The bank is still open. The lights are on, the tellers are at their desks, and you still can't have your money. This happened less than 6 years ago, not in theory, in real life, to millions of people who believed exactly what you believe right now. Imagine it's October 2019. You're in Beirut. The city is warm, the way it always is in autumn. You have a job, a family, an apartment you've been paying for over the last 8 years. You're not rich. You're not poor. You are, by any reasonable measure, financially stable. You have savings, real savings, not just a little buffer sitting in a bank account that you've maintained for years. You read the news in the morning the way everyone reads the news. You see that there are protests forming downtown. Students, workers, families, they're upset about a proposed tax on WhatsApp calls. You find it strange, a tax on a messaging app, but these things happen. Governments make strange decisions. You go to work. By the end of that week, the streets are not about WhatsApp anymore. They are about everything. The cost of bread, the cost of electricity, the fact that the country has been running a deficit for 30 years while the political class accumulated wealth at a speed that defied any logical explanation. By the second week, the prime minister has resigned. And somewhere in that chaos, quietly, without announcement, without a formal law, the banks make a decision. Not tomorrow, not later. Now, they don't call it confiscation, they call it restrictions. Informal capital controls, a limit on how many dollars you can withdraw per week, then per month, then the limit shrinks, then it applies to transfers. Then your Lebanese pounds are converted to dollars at a rate that has nothing to do with the real exchange rate. You go to the bank asking for $100 and leave with the equivalent of 11. No law authorized this, no court ordered it, and yet it happened anyway. The central bank issued guidelines. The banks followed them. There's the first, and your money, the money you put there in good faith, the money you saved, the money that had your name on it in their system, became something you could see but not touch. This isn't a metaphor. This is how it works. Here is what most people believe about money in a bank account. And this is where they're wrong. They believe that when they deposit money, the bank holds it, stores it, keeps it safe in some vault or digital equivalent of a vault. They believe that the relationship is simple. They give the bank money, the bank gives it back when asked. The bank is a coat check. You hand over your coat, you get a ticket, you return and get your coat. This is not how it works, not even close. When you deposit money into a bank, you do not give the bank your money to hold, you lend it to them. Legally, the moment the deposit is made, that money belongs to the bank. What you receive in return is a promise, a liability on the bank's balance sheet that they will return an equivalent amount when you ask. You're not a customer. You're a creditor, and you're last in line. The bank takes your money and lends it out. Not just a part of it, multiples of it. The entire system depends on one assumption. Not everyone asks for their money at the same time. The moment that assumption breaks, the system collapses because the money isn't there. It was never there. That's the part nobody tells you. Imagine it's 2001. You're in Buenos Aires. You've spent your career as a school teacher, 30 years in the classroom. You're not wealthy, but you saved diligently. You have a dollar account at one of the largest banks in Argentina. Dollars, because you didn't trust the peso, because everyone knew the peso was fragile, because your accountant told you that dollar accounts were safe. In December of that year, the Argentine government announces the corralito, from the Spanish word for a small enclosure, a pen, a place where animals are kept from wandering off. Your money is now in the corralito. You can withdraw a maximum of 250 pesos per week from your account. The problem is that the pesos are no longer worth what they were. The problem is that your dollar account is being converted to pesos at a rate that makes no sense. The problem is that the conversion is not optional. You go to the bank, you stand in the line, you wait for 3 hours, you are told the system is down, you come back the next day, you are told there is a limit, you come back the week after that. The limit has changed, the rate has changed. What you thought you had is gone, not stolen, not lost, simply transformed by administrative decision into something worth a fraction of what you saved. The word corralito means the same thing in every language, a cage. In Lebanon, by the end of 2021, the Lebanese pound had lost over 90% of its value against the dollar. Depositors who had dollar accounts, specifically dollar accounts denominated in a foreign currency specifically to protect against this kind of collapse, were told they would receive their funds in Lebanese pounds at the official rate. The official rate was a fiction maintained by the central bank. The market rate on the street was 4, 5, 10 times higher. You had $100,000. You were given the equivalent of $11,000 in purchasing power. No one stole from you. No one was charged. The system processed the transaction correctly. It was legal. Access is not ownership, and most people never realize the difference. There is a principle that runs beneath every financial crisis in modern history, and it is almost never stated plainly. The principle is this: the system does not protect your assets. It protects its own continuity. When a bank is in trouble, the priority is not your deposit. The priority is the survival of the institution. When a government is in crisis, the priority is not your savings. The priority is the stability of the system. You are not the customer in that moment. You are the resource. This sounds extreme. It feels like a conspiracy, but it is written into the architecture of modern finance so explicitly that the terms have names. Capital controls is a technical phrase for restricting what you can do with your own money. Bail-in is a technical phrase for using depositor funds to recapitalize a failing bank. Financial repression is a technical phrase for keeping interest rates below inflation so that the real value of savings quietly erodes while the government reduces its debt burden. These are not emergency measures. They are tools. They are in the regulatory toolkit of every developed nation. The IMF publishes guidelines on their implementation. The European Union formalized bail-in procedures in 2014 with the Bank Recovery and Resolution Directive. Cyprus used them in 2013. Depositors with over 100,000 euros had a portion of their savings converted into bank shares. Not hypothetically, it happened. The mechanism exists everywhere. The only question is when it activates. Imagine it's 2013. You're in Nicosia, you run a small import business, you've kept your operating capital 400,000 euros in a Cyprus bank because the interest rates were favorable and the banking sector had a reputation for stability. You've heard the news about the Greek debt crisis, but Cyprus is not Greece. Your bank passed its stress tests. The regulator said everything was fine. In March, over a weekend, while markets are closed, while you cannot move your funds, while the decision is being made in rooms you have no access to, the Eurogroup reaches an agreement. Banks in Cyprus will be restructured. Depositors with over 100,000 euros will contribute to the recapitalization. The percentage taken varies by account. Some depositors lose 30%. Some lose nearly half. You find out on Monday morning. The banks are closed. ATMs are dispensing only a small amount per card per day. Capital controls are immediately imposed. You cannot wire money out of the country, you cannot make large transfers, you cannot access the bulk of your funds. The controls last for 2 years. 2 years without access. By the time they're fully lifted, the business environment has changed. Clients have moved. Suppliers have found other partners. 2 years of restricted cash flow in a small business is not a setback. It is usually the end. This did not happen to irresponsible people. That's what makes it dangerous. This did not happen because of bad decisions. This happened to people who followed every rule, trusted every institution, and discovered that the rules were not written for their protection. There is a phrase that financial regulators use that most people never hear: systemic risk. It means when the potential failure of a financial institution or a cluster of institutions threatens the stability of the broader system, normal rules can be suspended. The usual protections can be overridden because the system's survival is considered more important than any individual claim within it. What this means in practice is that your deposit guarantee in the US, it's $250,000. In the EU, it's 100,000 euros, is not a guarantee that you will be made whole. It is a guarantee that the government intends to try under normal conditions. Under systemic risk conditions, the calculation changes. Cyprus had deposit guarantees, they were overridden. Lebanon had a functioning central bank with formal banking laws. The informal controls never required a law. What is visible to the system is controlled by the system. Your bank account is, by definition, completely visible. Lebanon's crisis did not begin in October 2019. It began decades earlier in the structure of how the country financed itself. After the civil war, Lebanon rebuilt on debt. The government borrowed heavily to fund reconstruction and maintain a fixed exchange rate, the Lebanese pound, pegged to the dollar at a rate that required enormous dollar reserves to sustain. To attract those reserves, Lebanese banks offered extraordinarily high interest rates on dollar deposits. Money flowed in. The banks then deposited that money at the central bank, which paid even higher rates in return. The central bank used those dollars to maintain the peg. This is a circular system. The banks attract deposits with high rates. The central bank attracts bank deposits with even higher rates. The government borrows from the central bank. The interest payments on the government debt go back to the central bank, which pays the banks, which pays the depositors. As long as new money keeps entering the system, the circle continues. The moment inflows slow, the moment confidence wavers, the circle breaks. Because there is no underlying engine. The returns were not generated by productive economic activity. They were generated by the promise that more money would keep coming. By 2019, the Banque du Liban, the central bank, held dollar reserves that were primarily composed of money it had borrowed from commercial banks at high interest rates. The reserves were not real in the sense that they could not be used without triggering the collapse of the very institutions that provided them. The system was, technically, already broken. It just wasn't visible yet. It was functioning only on confidence. Confidence ended in October. What happened in Lebanon is not a Lebanon story. Strip away the specifics, the civil war, the political dysfunction, the regional instability, and look at the structure. You find it everywhere. A government that needs to finance spending beyond its tax base, a banking system that attracts savings with high returns, capital flows that sustain an artificial stability, a moment when the sustainability of the model becomes undeniable. And then overnight, or over a weekend, or in the span of a regulatory guideline issued on a Tuesday, the rules change. Greece in 2015, capital controls imposed in a single night, banks closed for 3 weeks, ATM withdrawal limits of 60 euros per day per card. People who had money in accounts, who had done nothing wrong, who had simply trusted a bank in a country that was part of the European Union, could not access their funds. Iceland in 2008, Argentina in 2001, Cyprus in 2013, Lebanon in 2019. Different countries, different decades, different political systems, different currencies. The mechanism is the same. This is not coincidence. It's a pattern. There is a specific moment in every one of these crises that is worth understanding. It is not the moment of collapse. It is the moment before. In the weeks before Lebanese banks began restricting withdrawals, people who were paying attention, people who had friends in banking, people who understood balance sheet dynamics, people who read the right signals began moving money. Transfers went out, dollar accounts were drained. By some estimates, billions of dollars left the Lebanese banking system in the months before the controls were imposed. They were allowed to leave because there were no controls yet. The controls arrived precisely to stop the remaining depositors from doing what the early movers had already done. This is how it always works, every time. The people with the best information, with the closest connections to the system, move first. By the time the average depositor understands what is happening, the doors are already closing. The controls are not a response to the crisis. They are the mechanism by which the costs of the crisis are distributed away from institutions, away from those who moved early toward those who trusted the system and stayed. The price of trust in these moments is enormous. After the restrictions were in place, Lebanese depositors did something that would have seemed absurd before October 2019. They began entering banks with weapons, not frequently, not organized, just individually. People who had spent their lives building savings, who had deposits that represented their entire financial identity, who had tried every legal channel and been turned away, who walked into a bank and demanded what was theirs at gunpoint. Some succeeded. They got cash. They walked out. This is what the erosion of institutional trust looks like at the extreme. Not revolution, not organized resistance. Just individual desperation, rational by its own logic, operating in a space where the social contract had already been dissolved by the institution that was supposedly protecting it. The bank had already broken the implicit agreement. The depositor was simply responding to that reality. The principle that runs through every one of these events is uncomfortable, precisely because it has no clear villain. The Lebanese banks did not set out to trap their depositors. The Argentine government did not plan the corralito as a theft. The Cypriot authorities did not design the bail-in out of malice. Each decision was made under conditions where the alternative, total systemic collapse seemed worse. Maybe it was worse, maybe not. Maybe uncontrolled collapse would have caused more harm. This is genuinely debatable. What is not debatable is that in each case, the cost of preventing collapse was distributed to the people who had no seat at the table when the decisions were made. The depositors, the savers, the people who believed that putting money in a bank was the responsible, safe, boring thing to do. The system did not protect them. The system used them, quietly, legally, systematically. Visibility is vulnerability. The moment your money is visible, it's controllable. If an asset exists within a system, if it is recorded, tracked, reported, regulated, then the system can reach it and change the rules around it. The access can be restricted. The conversion rate can be changed. The rules governing its use can be rewritten. This is not a fringe idea. It is the operational reality of modern financial infrastructure. Every bank account is visible. Every brokerage account is visible. Every pension fund is visible. The regulatory apparatus knows where the money is, and that knowledge is the precondition for control. What the system cannot see, it cannot reach. This is not an invitation to criminality or evasion. It is an observation about the relationship between visibility and vulnerability. When the system is stable, visibility is fine, convenient even. When the system becomes unstable, visibility becomes the mechanism through which your assets are accessed by parties other than you. The question is not whether this will happen where you are. The question is what you understand about the nature of the thing you think you own. You have money in a bank, you believe it is yours. In ordinary times, for practical purposes, it behaves as if it is yours. You can access it, spend it, move it. The system reflects your ownership back to you every time you check your balance. But ownership, in the legal and structural sense, means something specific. It means that your claim on an asset is prior to the claims of others. It means that the rules governing your asset cannot be changed without your consent. It means that you can access it regardless of the condition of the institution holding it. By that definition, you don't own what's in your bank account. You have a claim. You have a promise. You have a number on a screen. The distance between that number and money you can actually use is not measured in dollars or euros or pounds. It is measured in the stability of the institution holding it, the solvency of the system around it, the political will of the government overseeing it, and the moment in the cycle at which you happen to need it. In good times, that distance is zero. Everything works. Everything feels safe. In bad times, it becomes everything. Somewhere right now, there is a family in a country with a stable government, a functioning banking system, and decades of institutional trust putting money into a savings account because that is the responsible thing to do. The same families existed in Lebanon in 2018, in Cyprus in 2012, in Argentina in 2000, in Greece in 2014. They were not naive, they were not irresponsible, they were operating on the same assumptions you operate on today. The same assumption that the number on the screen corresponds to something real. That access means ownership, that the institution's promise is the same as the thing promised. They were wrong, not because they failed to read the signs, most signs are only legible in retrospect, but because the belief they held was structurally incorrect. The belief that a bank deposit is your money is false, not legally, not in the way finance actually works. You don't own it, you've lent it. The question worth sitting with is not what happened in Lebanon. It's simpler and more uncomfortable. If the rules changed tomorrow, quietly, administratively, over a weekend, what would you actually have?